Once someone stops paying rent, it takes about 8 to 9 months to evict them, which is theft, right? These people are living your asset without paying for it, and that causes massive losses not only to you, but if you have investors as well. Self-storage is the opposite. Self-storage is not viewed as a basic human right, so the laws are written very in the favor of the owners of self-storage units.
Fernando Angelucci joins me here, and you can find what his team can help you with by heading over to SSSE.com. That's going to be a clickable link in the show notes. But if you hold on, he's also going to share his phone number, so he'll be brave enough to do that towards the middle of the episode. So I really appreciate your time here today, Fernando.
Yeah, thanks for having me on.
So you've built SSSE around tax-advantaged self-storage with focus on downside mitigation and social stewardship.
Correct.
What does that mean in plain English to investors listening over coffee?
Yeah. Number one, if you got a tax problem, investing in our assets can help you reduce anywhere between 50 to 90% of that tax hit at the end of the year. We do this using cost segregation, bonus depreciation, also partial asset disposition, and then solar panels as well. So Section 179. So that kind of ties into the social stewardship aspect, not only for the environment, but then we also, self-storage is a very localized, hyper-localized industry. Usually 90% of our tenant base comes from a 15-minute drive time. So what we like to do is kind of give back to the local communities. Free pictures with Santa. We support book drives, back to school supplies, animal shelters, anything that has to do with a local community outreach program. And we usually allow our local managers that are the boots on the ground to spearhead those, bring us any idea that they think that they feel strongly about and that could help the people in our community.
Sure. Well, that will actually bring me to something later that I can maybe help you with regarding if you're that active in your community, there's ways to really increase your search engine. I should call it's more AI engine these days regarding the signals that you send to from your website. But what's one misconception about self-storage you still hear to this day?
Yeah, so there's a few. So the first one is that everyone thinks it's these old school, first generation Class D facilities that it's like on a gravel lot with, a couple barns on it or sheds on it. That's not what we do. We're a Class A operator, so we build kind of like those office building looking, state-of-the-art technology, state-of-the-art security. That's what we do. So that's one of the misconceptions that I always have to get through to when we're dealing with, let's say, debt providers. They drive past these self-storage facilities that were built in, the 60s, 70s, and we're putting up these Class A facilities. The other thing, which I usually hear from investors, is they think that the asset class is already played out. They saw it in Fortune magazine and they think everybody's investing in it now, so there's no opportunity. That's actually not the case at all. When you look at the breakdown of ownership, over 65% of the owners of self-storage facilities are considered mom and pop owners. These are people that typically own only one or maybe two self-storage facilities. Some of those kind of old school, built in the 60s, built in the 70s style facilities. The top six publicly, or I guess now top five publicly traded REITs, they own about 20%. And then that delta of about 10 to 15% is owned by the next 100 largest operators, which I'm a part of. So massive opportunity in the space right now over the next 20 to 30 years, specifically in the consolidation play. So that's what we like to do on one of our three rungs of the stool, if you will, strategies, which is buying these smaller facilities, doing a bunch of CapEx so that we bring them into the modern, century, and then putting them into portfolios of 10 to 20 properties apiece and then selling them up the chain to the publicly traded guys or the privately held larger REITs.
So you mentioned the solar panels. It does make a lot of sense because there's a lot of rooftop space that kind of goes unutilized on some of these things.
Absolutely. On our single story developments, we usually have about 100,000 square feet of roof space. That's a lot of space that is just white, not being used at all. And because self-storage uses very little utility, we actually become a net power generator. And that's kind of real big right now. You touched on AI at the beginning of the episode. These data centers that power these AIs are sucking up all the juice, all the electrical power and supply in the communities that they're in. And what that's doing is it's making the price of electricity rise for everyone, not just the data centers, because of low supply, high demand, prices go up. So one of the ways that we can give back is actually by creating almost like a microgrid. We can put up anywhere on the smallest size, 25 kW all the way up to, 100, 150 kW systems per building, depending on how much roof space we have. Our average roof space for our multi-story developments is about 40,000 square feet. So we have the ability to not only produce everything that we use, but then also give it back to the community, or in some instances that we're exploring now, actually putting in battery infrastructure where we can put it into the community during peak times of electrical demand, and aka peak pricing. So that not only helps us, that helps our investors by increasing our net operating income, by lowering expenses, but then also helps the community as well by adding additional power generation that is green.
Is that like a partnership opportunity, or do you have these things installed yourself?
Yeah, I've seen the model, I've run the numbers where you lease your roof to these power generation companies. I am not a fan of that because I like to own the infrastructure. By owning the infrastructure, not only am I in control of everything, but then also I get to use Section 179 or cost segregation depending on what phase of the project. So that's very large tax advantages for my investors. And we push through those tax advantages to all the limited partners.
Sure. Well, you famously jumped from the plane and built the parachute on the way, starting with 97,000 in credit cards. What pushed you to take that leap, and what was the first real estate win that told you, okay, this is working?
Yeah. So when I was 16, I read Rich Dad Poor Dad, and that kind of got me thinking maybe working at 9 to 5 is not going to be the best route for me. That being said, I still did get my engineering degree at University of Illinois. But very quickly after going to work for a Fortune 50 company, within 6 months of graduating college, I started doing real estate on the side, small single family and duplex deals in Des Moines and around the Des Moines, Iowa area. My very first deal was tiny. It was, I believe my net profitability was $2,500, but as a 22-year-old, $2,500 is nothing to laugh at. So I said, hey, if I can make 22 or $2,500 doing nights and weekends, imagine what I could do if I did this full time. So to scale up this real estate venture in the beginning, I didn't really have any money. I think I had $6,000 in a 401k. So I cashed that out. And then I went and I applied for something like 64, 65 credit cards in like a span of 1 or 2 hours. Because what I found out is that if you do them all at the same time, rapid fire, they don't see all the other credit applications at the same time. I don't know if that's true nowadays, but 2013, that definitely was the case. And I got something, I think it was like 10 or 12 cards approved via 2 different swaths of me doing this, and I immediately cash advanced the entire limit off of those cards. And that's how I started real estate. I lost 30 grand right off the bat. So that was just a big dip down, and then built myself back up. Within 13 months of graduating college, I quit my 9 to 5 job at that Fortune 50 company, and I went in full time flipping, buying rentals, and wholesaling residential-based real estate, and was able to pay off that debt and eventually parlayed into commercial multifamily. And then between 2016 and 2018, I sold off all of my habitation-based real estate and went full bore into self-storage.
What was the first big gut punch? That lesson you wouldn't wish on your worst enemy, but you're grateful you learned it early.
Yeah. Due diligence, due diligence, due diligence, and location, location, location. It doesn't matter how great the property looks on paper. If people don't see it, they don't know it's there. You're not going to get customers coming in or renters coming in. Same thing with due diligence. Everything may look nice on a spreadsheet. Sellers and brokers have ways of manipulating numbers to tell the story that they want. You should not take that at face value. You should do all of your own due diligence. And if you find anything that doesn't make sense, assume, once the seller shows a pattern of not being truthful. You just assume everything they tell you is a lie. So learn that very early on. I think it was on my 7th or 8th deal in the residential side of the world. And then over time started not only writing down my processes and procedures, but then systematizing them so that I didn't have to be doing all the work, and that allowed me to kind of scale my business to where it is now.
So you mentioned that you early on, you tried all kinds of real estate investing endeavors. Like, what in the end caused you to focus on the self-storage?
Yes, a lot of reasons. I'm sure you have a bunch of listeners out there right now that may be landlords or tired landlords. Number one is how the laws treat your investment. In most states, most municipalities, landlords are kind of viewed as these, money hungry, not always doing the best that they can for their tenants. And that usually isn't the case. However, there's always one or two bad eggs that causes laws to change. So for example, in Chicago, where I'm from, once someone stops paying rent, it takes about 8 to 9 months to evict them, which is theft, right? These people are living your asset without paying for it. And that causes massive losses, not only to you, but if you have investors as well. Self-storage is the opposite. Self-storage is not viewed as a basic human right. So the laws are written very in the favor of the owners of self-storage units. The second thing is government intervention. I mean, we saw what happened during COVID. It was a really bad time for everyone, but effectively the government said you don't have to pay your rent because there's no fear of being evicted for 2 to 3 years. But they didn't go to those landlords and say, hey, you can stop paying your property taxes or you can stop paying your mortgage. So that caused a massive amount of bankruptcy and foreclosures on the landlord side, the people that are actually providing the housing for the individuals in the community. So I didn't like that as well, how the government could just get involved into your private business and just put de facto rules across, 400 million people without actually knowing the individual cases. And then I'm a data's guy. I'm a engineer by training. So if you look at the last 30 years, self-storage has had some of the highest returns across any asset class that you compare it. S&P 500, retail, office, healthcare, residential, and even industrial. Here's some quick stats right here. If you had $100,000 to invest in 1994, by 2021, if that was in the S&P 500, you would have about 1.6 million, or about a 10.8% average annual return, which is nothing to scoff at. When you look at residential, it's about 14.4% average annual return. So that 100,000 would turn into about 3.8 million. But if you put it into self-storage during this almost 30-year time period, there is an average 18.8% annual return. So that $100,000 over that time period comes out to be over $10 million. So even though it's, from 10 to 18 is only 8%, or from 14 to 18 is only 4%, you got to realize that compounding is the eighth wonder of the world. So an extra 4% or 8% return every year for 30 years can really move the needle on wealth.
So what's your primary focus here now? Do you do new development, acquisition, value add, big box conversion? What are you focused on?
Yeah, we have 3.5 strategies, I'll say. So the first that we started with is the mom and pop roll up. So finding these smaller facilities that are not advantageous for the large players to buy, buying those, usually doubling the size, doing a bunch of CapEx so they look nice and new, putting in technology, so professional management systems, using AI in the pricing and the demand driving, and then putting those into portfolios of 10 to 20 properties. So now those individual properties that were not very sought after by the big guys, now they're looking at these portfolios of 10 to 20 properties where instead of stroking a $1 or a $3 million check, it's a $40 or a $50 million check to buy the portfolio. And now it makes sense for them. So that's strategy number one. Strategy two is ground up development. So these are going to be your class A monstrosities. They're 3 to 4 stories, usually 1,000 plus units, 100,000 net rentable square feet, or 80 to 100,000 net rentable square feet. We build them, we lease them up, and then we sell them usually one by one to the larger players. And then a strategy that we don't do much now, but was very big during the COVID days is adaptive reuse conversion. So buying these dormant big box stores like Circuit City, Walmarts, Kmarts, Sears buildings, and turning those into self-storage. It was great because it reduces our construction timeline, aka time that you're not making money, by about 30 to 40%, and then also reduced our construction budget, especially during that supply kerfuffle that we had where wood went up 500%, steel went up 140%, almost overnight over a 6-month period. So that helped us smooth that out. And kind of the half strategy is something called assignments of contract or wholesaling. That allows us to do a very large, broad marketing net, knowing that we're only going to cherry pick a few of the best deals for ourselves. But that doesn't mean that a third base hit or a second base hit somebody else doesn't want to buy. So that allowed us to build up a large list of about 3,500, 4,000 self-storage buyers that are a lot smaller than us, to monetize those leads, and then that money just goes right back into the marketing engine, allowing us to kind of touch every self-storage facility in the United States.
Just to remind everybody, we're talking to Fernando. You can learn more at his website. Go to SSSE.com for more information. And Fernando is brave enough to give out his phone number. So, Fernando, if somebody wanted to reach out, how did they get a hold of you?
Yeah, it's area code 630-408-8090. That's my real phone number. Feel free to text or call anytime.
And if you found some value in what we're chatting about so far, do us a quick favor, share this with one of your investor friends. It is the only way the show continues to grow. And if you are watching us on YouTube, give us a like and subscribe. So on the acquisition side of things, you've been known to find some pretty drastic discounts on some of these existing properties. Can you walk us through the top 2 or 3 repeatable tactics for finding and winning those opportunities?
Yeah. So number one is making sure that you're going direct to seller. I always make the analogy is when you're buying something through a broker, a listed property, it's the equivalent of going to an auction house that has 1,000 people bidding. I'd rather go to the auction house across the street where I'm the only bidder. Then I basically get to set my own price for what makes sense to me. I don't have competition against somebody else that is usually making either a bad decision or they have much cheaper cost of capital than I do. So making sure that you're going direct to seller. We do that with a multi-channel marketing approach, not only finding the individuals that we want to go after in the markets that we want to go after, but then almost forming a relationship and adding value to them, not just calling them and saying, hey, sell me your property. It's calling them and saying, hey, I see that you're going to the trade show, the SSA, would love to buy a drink and chat. If you need any resources, a nice insurance guy, maybe a new property manager, recommendations for software to help you run your facility better, more than happy to send that over to you. And when you stay in front of them over a long period of time, once they're ready to sell, you're usually going to be the first call because you're the one that's checking in every quarter, every 6 months saying, hey, Jack, is there anything I could do for you? Do you need anything? And once they say, you know what, I think I'm ready to retire. I want to go travel or spend time with my grandkids. I'm usually the first call.
Yeah, it's especially interesting. One of those things. It's all about timing in many regards, right? Just staying top of mind.
Exactly. I mean, some of the best deals that we've bought are ones where we have been in contact with that seller for over 5 years. So, really the perseverance side is what wins the race.
Yeah. Well, it kind of legitimizes you too, right? It's that you've been sticking around. So on the capital side, you syndicate deals and work with both accredited and non-accredited investors. What's working best today for raising and structuring capital in storage, and what changed in the last 12 months?
Yeah, so I think there's a couple ways to raise capital. There's a lot of guys that try to just kind of leapfrog a lot of the steps and go straight to a broker dealer. They're trying to get institutional capital. The problem with that institutional capital is typically the terms are not very advantageous. It sets up the project for risk. So what we decided to do is to focus on the people that really need these investment avenues, what we call the retail investors. These are going to be the average person on the street that just happens to have some additional investment cash. They're already, let's say, invested in the stock market, and they have maybe a little bit, they own a home or a rental property, but they want some more exposure to, say, commercial real estate or self-storage specifically. So what we found out is reaching those people is pretty easy. It's coming on here, talking to you. These people are going to your podcast to learn about investment avenues and what is good, what is not good, experiences people have, and then you bring on the best of the best to the show. So this is already setting up an easy way for people to reach out. Again, I gave out my cell phone number. So I want to try to eliminate as much friction between you calling me and saying, hey, Fernando, I was thinking about doing self-storage myself. Then I realized maybe I don't have the time for this. How about I invest it alongside you? And so what we do is we chop up a lot of our podcast views. We send people back to the original podcast. We use little 30-second clips or 3-minute clips, and we syndicate across all social media. So that's one way to reach people. Another way is by getting speaking engagements at the trade shows and the associations. So we've spoken many times at the Inside Self Storage World Expo, at the Self Storage Association, at Self Storage Mastermind groups, anytime, and then even local real estate events. So if you happen to be in Chicago, there's a RIA event, an REIA event. Most likely I'm going to be speaking there at one point in time with that information available on that RIA's website, et cetera. So what we found is that kind of the down and dirty approach of just meeting people works really well. We started bringing capital from outside investors in 2018, and to date, we're now over 1,000 retail investors. And it's not like these are people that are super wealthy. Our average check size is $135,000 across all of the deals we've ever done, the last 50 or so deals that we've done. And it's all because of these investors that they want the opportunity to get additional wealth. And we bring them the opportunities that are usually reserved for those private equity firms and those life insurance companies and family offices.
One of the things, I'm going to switch to marketing here for a moment. It seems like when you're attracting any kind of investors or you're selling a property, it's more around the story associated with it than it is like, here's the product and here's the bells and whistles. Have you found it difficult to build stories around these storage units?
Not really. So it's funny. Anytime you talk to anybody, usually they themselves have a self-storage unit that they've gotten 7 rent increases on over the last 3 years, or they know someone that has complained about it. So they know it's ubiquitous. It's everywhere. So prior to the pandemic, 1 in 11 households use self-storage. Post-pandemic, today we're at about 1 in 9, and we're seeing that moving in the right direction. And I think there's kind of 2 things around that. One is this generational divide. You have these late end of the baby boomer wave retiring or going into nursing homes in mass, something like 15,000 people a day. So they're going from these affordable ranch houses that they bought 20, 30 years ago that has 5 bedrooms into a 1-bedroom condo that's basically the same price, or into a nursing home that they could be paying anywhere between $8,000 to $12,000 a month, depending on what level of care they need. So they need a place to put all their things, and usually their kids don't want to take it. And if they do, the kids end up using the storage units. The other half is kind of the younger generations that are now getting into prime household formation age, and they're finding that it's very difficult to afford a home, especially a home of the size that they want. So what they usually do is they'll usually opt for a smaller home, or maybe a home that's in a walkable area so they don't need a car. And instead of getting a 5-bedroom home like their parents or grandparents did, they get a 2-bedroom condo, and then they use a self-storage facility as a permanent closet. We've seen many of that, not only in the millennial, but the Gen X generation as well. I think affordability is not going to get better anytime soon. The only real way to do that is just to open all zoning and allow dense residential to be developed everywhere. But I don't see governments allowing that. I don't see investors allowing that. I don't see the NIMBYs being very happy about an apartment building going up in a residential neighborhood. So the case for self-storage is a bull case, and I think it's going to only get better and better as a self-storage investor over the next 20 to 30 years.
So once you close on a facility, what are the top few operational upgrades you implement to create that value quickly?
Yeah, so great question. Number one is looking at the market pricing versus the existing facility. What we find is a lot of these mom and pop investors, they end up becoming friends with their tenants or their customers. They usually sit, half of the time they're the ones sitting behind the desk. They don't charge late fees. They're not checking their competitors to see what their competitors are offering as far as market rate. So right off the bat, there's times where we can come in and raise the rent anywhere between 20 to 60% just because the competitors are at that level. Number two is dropping expenses. So electricity costs with solar panels, management costs, labor costs by using a property management software. I can't tell you how many times I've bought a self-storage facility where I asked to see their books and their numbers, and they mail me a yellow legal pad with the last 6 years of that's all they've been using to operate their facility. So there's going to be a lot of inefficiencies in operating a facility like that versus what we do using a professional tech stack, using artificial intelligence to help with pricing, dynamic pricing, see which tenants can absorb a higher increase in rents, which ones cannot, based on things like what type of credit card are they using? Are they paying in cash or are they using Amex Platinum? Maybe the guy that uses the Amex Platinum and has social media posts out there have him flying first class is not really going to care about a $30 increase in his monthly rent versus the person that is habitually late, 5 to 7 days late every month and pays in cash. That person probably cannot absorb a rent increase. So that's number two. And then CapEx. People don't like to go to facilities that look literally and figuratively shady. If you walk, let's think about the average user of a self-storage facility. Typically suburban mother with children in general, or if it's someone else, they're the one that's going there. So do you want your wife or your sister or your daughter to go to a poorly lit self-storage facility where dangers can be lurking at every corner? Absolutely not. So number one is make sure that we got a well-lit, clean, presentable self-storage facility. Add in security measures, fence the facility, put in keypad gate access and exit. So that means that we can track everyone that's going in and out based on their unique keypad number. If it's a climate control or interior self-storage facility, make sure that there's keypad access to certain parts of the building. There's no reason someone needs to go to the third floor if their unit is on the first floor. So they need to put their keypad code into the elevator to get to the third floor if they have a unit up there. So that CapEx side is super important, not only to make it look nice and presentable and attractive for new customers that want to come in, but then make it safe. And then the last piece is just a comprehensive social media and internet strategy. I can't tell you how many self-storage facilities I've bought where they don't have a website. They're not on Google Maps. You wouldn't know they exist unless you happen to drive past them. And today's day and age, the very first thing somebody does when they're looking for a service is they Google it. Self-storage in Chicago, self-storage in Yorkville, etc. So if you don't show up on that, you're losing almost 60% of the traffic that your competitors are stealing away from you. Those are three very easy fixes that you can buy a self-storage facility and then within 3 to 4 years, sell it at twice the price you bought it for.
So you've scaled to, and maybe this number is wrong now, but I had seen $250 million in storage assets at this point.
Correct.
Where
yeah, we have a.
No, go ahead.
Yeah, so we it was a very interesting start. In the beginning, we bought facilities just with our own cash, and then very quickly our cash ran out. Then we started going to friends and family, and then very quickly the friends and family cash ran out. So then we had to create a professional, almost investor marketing company on the side of our self-storage company to attract those types of investors, then listen to see what they wanted, what type of terms they needed, what was competitive in the market. So once we started bringing outside capital, our ability to buy additional self-storage facilities really skyrocketed. And then once you start having additional revenue come in, that allows you to hire full marketing teams to go out and find additional self-storage facilities. Yeah, up until recently, we've been doing everything via single asset syndications. We are now launching a fund that is a GP fund. It operates as the GP partner next to me and my co-owner, Steven. But we still have the ability for people to, hey, I'd rather, it's kind of a two different strategy. There's the people that like to bet on the horse. So the story of that individual self-storage facility. And then there's people that like to bet on the jockey. They say, I like Fernando. I like the way he thinks. I like the way he picks assets. I want to invest with him. Everything he does, I want to invest on his side. So what the fund allows you to do is basically spread out your investment as opposed to, say, investing 50 grand. Let's say you only have $100,000. You can only get into 2 self-storage facilities. But if you go into the fund, which is $100,000 minimum, that $100,000 can now be spread across 10 or 20 different assets. So you're not only diversifying on a asset strategy type. Is it a ground up development? Is it a turnaround value add? But then also geographically, a little bit of the Midwest, Southeast, Northeast, what have you.
When it comes to your operations, where have you seen the most strain or bottleneck?
Yeah, so this is a great question. Debt has been very rigid over the last couple years. It is starting to open up quite a bit, but it was tough. I mean, we had that situation where a lot of banks were buying sub 1% bonds when interest rates were low, and then interest rates started going up very quickly. And now they're sitting on an asset that, if they had to fire sale, would go for pennies on the dollar. And we saw things that, just a couple years ago, when there's a run on the bank and they don't have liquidity, you see things like Silicon Valley Bank going down, Signature Bank going down. And then the government had to step in and offer a type of repo facility to stabilize these banks. And they remember this, this traumatic period a couple years ago. So what that basically forced us to do is get very good at negotiating seller financing. So the sellers become our bank, which allows us to get below market interest rates at longer than market timelines with the ability to be in control of the loan docs. So when you go buy money from or borrow money from a bank, they give you the contract and they basically say, sorry, no negotiations. Here's the clauses. When you're dealing with a seller, everything is negotiable. Can I substitute collateral? Let's say I get a 10-year note, but I'm ready to sell the asset in 3, but you're really hoping that I would keep paying interest payments for another 7 years. Well, how about we substitute? We take this debt off of this facility I'm about to sell and put it onto a new facility that's of equal or greater value. These are things that banks would never allow you to do, right? It's just not in their purview. So that helps us a lot. And now what we're starting to see with interest rates going down is banks are starting to open up a little bit of liquidity. So the conventional lending markets are starting to open up a little bit, still not to the level it was, let's say, during the zero interest rate policy days, but it's getting better.
So you've mentioned using AI a couple of times here throughout the episode. Can you talk a little bit about the technology that you're leveraging, maybe some automation, and how you're using AI to maybe find, underwrite, whatever these opportunities?
Yeah, so I'll break it apart. So on the operations side, self-storage has been quite a laggard when it came to implementing technology into the space. So on the operations side, for example, we use a software that it does kind of 3 things. The first is dynamic pricing. So it will check competitor rates, and then it will also check how often someone is Googling self-storage in a target market. So let's say I own something in Champaign, Illinois. If all of a sudden we see a massive spike in Champaign, self-storage units in Champaign, Illinois, it will catch on to that and automatically start dynamically pricing our units. So that's number one. The second one is it does a good, better, best. So instead of all 10 by 10s being $150, they'll say, okay, the market rate's $150, but if you want, that's for a unit that's on the 3rd floor at the very end of the corner of the building, farthest away from the elevator. If you want something on the 3rd floor next to the elevator, that's going to be the better unit. That's actually going to be $160. Or if you want a 10 by 10 on the 1st floor right next to the front door, that's going to be $170 for the best unit. And what we found is that when we implemented this, our increase, we had almost 35% increase in people upgrading to a better located unit, as opposed to treating all 10 by 10s, the same. The airlines have learned this a long time ago. You want to sit in the exit row, that's an extra fee. You want to sit at the front of the plane, that's an extra fee. Or the base ticket, you get to sit in the back of the plane where there's the most amount of turbulence, right? So that's number 2. And then number 3, which I kind of talked about already, is going through our existing tenant base, seeing everything that's publicly available about them, not only from our systems, but then people give out a ridiculous amount of personal information on the internet by posting things onto social media on open accounts. So I can see the guy that, like in the example previously, the guy that's using the Amex Platinum to pay his bill automatically every month and is showing photos of him being in Monaco, probably willing to absorb a much larger rent increase. So the software will actually go through and price everybody on a scale of 1 to 10. So usually the 1 to the 3s and 1 to 4s, we usually don't raise the rent at all. The fives to the eights, usually a modest increase. And then the nines and the tens usually get a pretty large increase to the tune of sometimes 26% a year. And that's all comes with basically no additional expense. So that goes all to the bottom line. That's all revenue. So that's on the operations side. On the acquisition and the equity side, every company that we use that we already have software is now rolling out their own AI platforms on those softwares. And that's making underwriting go faster. That's making identification of acquisition targets much easier. Before, we used to have to slog through multiple different types of data sets that we had to acquire ourselves. Now it's just all built for us. And then same thing with the equity raising side. Investor relations is not for the faint of heart, especially when you're like me. We have over 1,000 investors. That's a lot of conversations. That's a lot of K1s. That's a lot of updates onto the portals. Well, now we're using AI to leverage our time. So I can roll out, for example, here's a perfect example. Before, I would get a K1 package or multiple K1 packages, depending on how many assets. And then I would have to individually upload those K1s, individual investor portals. That would take a long time. Now, the AI will actually read through all the documents, automatically match the document with the investor, and automatically upload it into their account just by being able to read the document digitally. It's amazing. That alone has saved hours and hours of times at the end of each quarter for me, at the end of each year as well. And so it's very interesting to see all over the self-storage space, AI is starting to roll out and is truly saving hours of everyone involved.
And if that sounds like magical to you and would like some help, that's what we do at Real Deal Crew. So a self-plug there. So head over to realdealcrew.com. We can help you implement some of these solutions to get similar results. Well, Fernando, this has been a fantastic conversation. Before we jump into the rapid fire and close out this episode, is there anything else we should have tried to hit on?
I think we got a lot. And I always tell people obviously I'm very passionate about this. I know it's odd to be passionate about metal boxes on concrete slabs, but I am. So if you have any questions at all, feel free to reach out. You can either, if you're a passive outreach person, go to the website, SSSE.com, and book a time to chat or chat with us on the function there. Or if you're more of an active outreach person, feel free to call or text me. I'm always happy to chit chat self-storage. That's what I love to do.
Well, if you're ready, Fernando, let's jump into the rapid fire and close out this episode. What lie do real estate investors often tell themselves?
That I'll refi later. It's okay to get a rate that's higher than my cap rate right now. We saw a lot of people lose their shirts dating the rate and marrying the house, if you will, as opposed to always being rate sensitive, regardless of where you think the economy is going to go and if rates are going to go up or down.
If you could go back in time and give your younger self a piece of advice, what would it be?
Yeah, start bigger. I started on $25,000 to $100,000 houses because I thought that was the stair step that you had to take. Turns out every time you add a zero onto the debt and the equity, it gets easier. So I wish I would have gone directly into $10+ million real estate deals as opposed to wasting my time doing these $25,000 and $100,000 deals that really didn't make any money. It just brought a bunch of stress.
Do you have a book recommendation, or what are you reading right now?
I have so many. I'm an avid reader. My Audible account has over 600 books in it right now. I guess I'm an avid listener. I'm not an avid reader. A few things. So one that's not business related that I've taken to heart, there's a book called Vagabonding, The Forgotten Art of Long-Term World Travel. I'm actually recording this from Brazil right now. That's one. If it's a business one, I would say Traction by Gino Wickman. It shows you how to get a grip on your business, how to basically run your business using an operating system, entrepreneurial operating system, EOS. And then if you want fiction, I've been reading a very interesting series called Red Rising. It's a sci-fi fiction about what happens to the world when corporations end up taking over and colonizing other planets in profit.
I actually have that series in my Audible too, and I haven't gotten to it yet.
Very good. I really recommend it.
Yeah. The one sci-fi book that is stood out for me, and I've listened to it twice, is Ready Player One. I just can't get enough of that. That was a
great book. Love it.
And then finally, what single process or tool have you implemented that has saved you the most time?
Okay, I'm going to give a boring answer, but if you ever catch yourself doing anything twice, the exact same thing twice, you need to stop, write down every step in brutal detail, because that is the only way to save time, is by taking everything out of your head and allowing someone else to do it that is at a fraction of the cost of what it costs you. So if you know that for whatever reason, your hourly rate's $100. I can guarantee you almost all of the tasks that you're doing right now. I'll say 80% of tasks you're doing right now can be done by someone that is a lower dollar cost per hour than you.
Well, Fernando, this has been fantastic. Really appreciate your time, and we'll be in touch very soon. But one last time, it is SSSE.com. You can find more details there.
And then my cell phone number is
Well, thank you, sir. We'll be talking to you very soon. And again, you're welcome back anytime. I hope you'll take me up on that.
Absolutely. I love talking storage. I like talking macroeconomics. So anytime you want me, I'll be back.
Thank you, sir. Have a great one.
You too.